Hello, I'm Maria Dawes, and welcome to another edition of Your Wealth Matters. I'm joined by my colleague and fellow portfolio manager, Janet Kinsing. Hi, Janet. And today we're talking about planning for retirement income. We spend our working lives in what is termed the accumulation phase, and essentially that's saving for retirement. And when it then comes to accessing these savings, it can be really overwhelming. So to help today, Janet and I would like to discuss four key concepts. Pension income splitting, the spousal RSP, when to take CPP and OAS, and finally, adjusting your risk profile as you prepare for the distribution phase.
Hi, Maria. That's an ambitious agenda, so let's get to it. In many ways, the conversation of pension income splitting and a spousal RSP can be tied together. You can begin to split pension income at age 65, and eligible income for pension income splitting includes withdrawals from your retirement accounts, including RIFs, LIFs, and any other pensions you may have. An important point of clarification is that CPP and OAS are not considered eligible income for pension income splitting. Now, the good news is that most of today's tax software is sophisticated enough to do the pension income splitting for you in order to affect the most favorable outcomes from a tax perspective. Maria, now let's explain the spousal RSP and how that intertwines with pension income splitting.
Sure. So what a spousal RSP essentially does, it allows the contributor, who's usually the higher earning spouse, the deduction from their income. And when it is eventually withdrawn, it is counted towards the annuitant, so the lower income spouse's income at presumably a lower tax bracket, right, compared to the contributor. Again, this would be a moot point once income splitting is in effect at age 65. However, there's a chance that you may withdraw from the spousal RSP before income splitting comes into effect, that is before age 65. And then it can have its uses as it would be taxed at the annuitant's or the lower income spouse's tax rate. Also, sometimes the higher earning spouse will still earn a small employment income through early retirement. And since that income split can't happen with that earned income, the lower earning spouse could then withdraw from the RSP at a lower income tax rate, and it would be useful in that case. So there are certain uses in having both spouses holding their own RSP accounts, but just a quick side note here, if you're contributing to a spousal RSP, don't forget to watch the timing on when you make the withdrawals, because any withdrawals done within 2 calendar years of the spouse's contribution, it'll be attributed back to the original spouse who contributed. So the higher earning spouse, they'll have to claim that income on their tax return if it's within a 2-year time period. So you do need to pay attention to the attribution rules when withdrawing, when you're making those withdrawals. So that's important to remember.
Thanks, Maria. Our next point addresses one of the questions we're commonly asked, and that is the timing of when to take CPP and OAS. It's a big question with no one-size-fits-all answer. I would say it will depend on many factors, including current income, whether you're at risk of being clawed back on OAS. It also depends on your health and life expectancy, which is not always easy to know or predict. And of course, whether there is a need for the income. We have clients who believe a bird in the hand is worth 2 in the bush, which has its merits, and others who feel they could achieve a rate of return equivalent to the decrease of 0.6% per month or 7.2% per year that would occur when taking CPP out at age 60. And there are others still who prefer to defer until age 65 or even beyond that so they can receive the higher payments. So again, there are many factors that can influence this decision. For OAS, you are eligible only at age 65. And while you can delay payment, those decisions could again be circumstantial depending on your tax bracket, given that OAS can be incrementally clawed back beyond a certain income level, which is adjusted every year. So there's a large component that is personal preference, which will involve consultation and discussion with your portfolio manager, which is why it's difficult to provide a hard and fast rule. Maria, let's shift gears and talk about our final point today, and it's an important one: adjusting risk profiles as time horizons decrease. Or said differently, making sure there isn't too much risk on the table considering your stage of life.
Yeah, Janet, to that point, I just read an article the other week about the importance of retirees developing an income strategy versus a growth strategy within their portfolios. And there really is a difference because as you age, your portfolio should be shifting to accommodate a totally new objective. It's an income focused objective. And far too often, we're working with people who come to us with portfolios that are really stretched on the risk side, which doesn't serve a new objective or the income objective. Then they run the risk of needing to draw their income at a potentially inopportune time. And in today's markets, this is becoming more of a concern because we've got such increased volatility in the traditional markets. Additionally, they may also be underestimating their emotional tolerance for risk as they enter this new phase of life, because they know they can't add to their portfolio very easily if they have sustained losses. And extending their risk profile or just not applying the right strategy at this stage of their life can be really stressful. And that is the last thing you need when you're going into retirement or are already in retirement. So as you enter retirement, a little self-awareness and honesty about your overall financial picture is important, as well as reevaluating your portfolio objectives and making sure that your investment strategy will actually fulfill your objective. And of course, we can help you with that.
Such a good point to close on, Maria, and well said. If you have a question or a subject that you'd like us to discuss here or in person, please don't hesitate to be in touch. Thank you once again for joining us on another edition of Your Wealth Matters.
Bye for now.